I'm doing my like taxes, I guess at the end of the year, I know I'd have to recognize the cash flow as income if I
Mhm.
was taking that as income, but that would be about it though,
Yeah.
right?
So you will recognize it as income and you'll be taxed on it, I guess, to a certain extent. But think about it this way. Let's say you make $1,000 of rental income.
Mm-hmm.
You're only going to be taxed on it if it's profit. So
Okay.
as a business, you're only taxed on money that is profit rather than earned money, right? So if you make $1,000, if the question is how much am I going to be taxed on this $1,000, the answer is depends on what your expenses are. If it costs you $100 to make that $1,000, you're going to be taxed on $900. But if it costs you $1,000 to make that $1,000, you're not going to be taxed on anything. And
Right.
so the reason this is important is because there's a very distinct difference between what you consider cash flow or earned income and what the IRS recognizes as taxable. And it's favorable for you if you're in real estate. I've got a video on this on how is my money, or a webinar on how is my money tax free that might be helpful to look at for more granular detail. But suffice this. So let's say you've got $100,000 property, or let's say it's a $70,000 property that you're renting out for $1,000 a month. So that means that out of $1,000 a month, let's say 300 of it, or if it's a 70,000 property, 400 of it is a mortgage, right? So right now you're down to $600 cash flow, right? And then let's say 300 of it goes to operational expenses like your insurance, your taxes, your maintenance, property management, all that stuff. So you're walking away with $300 a month, right? After those expenses. That's $300 in your pocket. But the IRS also calculates depreciation, which is the natural wear and tear on a property. So they have decided that the natural wear and tear on a property occurs over 27 and a half years. How they got to that number, I don't know. So, but they actually quantify how much you can depreciate and calculate in how much you lost in the natural deterioration of your property. So if it's a $70,000 property divided by 27.5, that means that $2,545 every year you can write off. So that comes out to $212 a year. So now we're down to about $90 of cash flow. But on top of that, you had, in order to make that house worth $70,000, let's say you put 25 grand into it, right? So that would be, you can do a cost segregation analysis, which allows you to depreciate that amount of money over a shorter period of time, usually about 5 years. It depends on the specific item that you're depreciating. Sometimes it's 1, 3, or 5. But if you're doing something like a roof, you can depreciate that over 5 years. So now if you've got another, so we're down at $90, but if you've got another $25,000 divided by 5 years, that's $5,000 a year. So that's $416 a month, right? So minus $90, that means it looks to the IRS like you're losing $326 a month.
Okay.
Right. So the IRS is saying, golly, Bree is losing $326 a month. So that is times 12. You're losing about $4,000 a year.
Yep.
Right. So if you got properties just like that one, let's say you had 10 properties like that, that means you're losing about $40,000 a year. That's what it looks like to the IRS. So if you were to make $40,000 somewhere else, that money would be offset. So instead of you getting taxed on that money, it's offset with the cost of operating this business over here. All right. And they allow you to take that loss and apply it to W-2 income earnings up to $150,000. So let's say your salary was $80,000 and you had 20 properties. That means that you're now offsetting that taxable income of W-2 money to where you're not taxed on that either, which is a big deal because $80,000, 40% of, let's do this, $80,000 times 0.4, that's 32 grand that you would not see in your pocket. But because you're able to offset it, now you keep $32,000 in your pocket instead of letting it go to the government.
Yeah.
It's a big deal. So that's why it's crazy that if you're making, say, $400 a month just on one property, right? That's the equivalent of, $4,800 a year.
Mm-hmm.
And let's say you're doing that over 10 properties. So $48,000 a year, $48,000 in tax-free world is the equivalent of almost $80,000, depending on tax, 35 to 40% tax rate. But it's the equivalent of someone making $80,000 a year.
Yeah.
Right? So if you're making $60,000 and you're getting $60,000 in your pocket, it's the equivalent of someone making $100,000 but being taxed at the 40% rate, which would include federal, state, and local income taxes. Right? That is one of the beauties of real estate. You've got the short-term benefit of cash flow, you got the long-term benefit of equity growth or principal pay down, appreciation. But the middle part, the medium-term benefit of tax sheltering is incredibly valuable.
So that's super interesting, because I think in my freedom number, I may have included taxes before I really understood how the taxes worked. So I now need to go back and look at my freedom number, because it's probably a lot lower, because I probably included taxes on that. Because theoretically, if I was only living on my cash flow for my properties, I wouldn't really be paying any income taxes. Is that a true statement?
Right. This is where the general public, a lot of people say like, oh, you didn't pay taxes, but you did pay taxes in a different way, right? Yeah. You're following the rules, and the IRS says if you don't make any money, then you can't be taxed on making nothing, right? And then they determine what they qualify as making money, right? So for example, let's say that you made $20,000 of taxable income because you're cash flowing way better than you were when you started, let's say 5 years down the road.
Yeah.
Now, if you were to just buy a house that was in an appreciation market and you were like breaking even or maybe making $50, you would offset a lot of that income on the other side. So you get the benefit of the appreciation without really caring if it cash flows, because it's offsetting the taxability, right? The tax burden on some other property of yours.
Yeah.
Right? That's how you can continue to keep. It's not about how much you make, it's about how much you keep, which is what Kiyosaki says, which is a really powerful principle to learn.
Yeah. Wow, that's interesting, because you definitely don't need as much. You don't maybe need like an $80,000 salary if post taxes that's what you're living on. You would just need. That's interesting.
Yeah, because if you're making $100,000, you're really only seeing $60,000 in your pocket,
and that's all you would need. Wow, right. That just like was a game changer at matching my salary. I just didn't even think about it that way.
This is an area, I mean, the taxation side of things. This is why Kiyosaki says that one of the most valuable skills to have is accounting. And I think part of the reason he says that is to be a little bit contrarian and, for lack of a better word, clickbaity, so that people will listen. Because when people think accounting, they think like accounts receivables, accounts owable, like all of that stuff. But they don't really think about the natural implications about taxes in their everyday life, right? So, for example, like when Brittany and I, we were up at the doctor earlier, and we went to pay for it. Her LLC pays for all of her medical expenses. So all it does is it changes which card we use, right? We use her LLC's card, her business's card, because it pays for her medical expenses, right? That is one practical way that it changes, but it doesn't change like fundamentally everything, right? You just have to better understand how these expenses relate to your business and how you're going to pay taxes on them. And so when he says accounting, he really means the understanding of how things are taxed and how you earn money. And that's a really, really powerful thing to learn. So as you guys have any questions about that, I'm happy to talk about it. I love nerding out on that stuff. And that understanding of taxes is what defines and differentiates those that are wealthy from those that are poor. That might sound really aggressive and really harsh, but it's true. And some people, when I teach on financial literacy every now and again, particularly when I'm teaching like new grads or even college students, oftentimes they'll say, well, that's not fair. And I agree, it's not fair, but it is the rules of the game. It's kind of like arguing with, if you're playing Monopoly and saying, well, they're getting $200 when they pass go, why aren't I? The answer is because the rules say you can take $200 when you pass go. Just because you haven't been taking $200 doesn't mean the game is wrong for some reason.